Hello everyone, in this video, let's have a brief review of Chapter 7, Variable Costing and Segment Margin, and then we'll review a few homework practices from the chapter. The difference between variable costing and absorption costing, we already actually seen the applications in Chapter 6 when we use the traditional income statement, which is under the absorption costing assumption, or the contribution margin income statement, which is consistent with the variable costing concept. Under the absorption costing concept, the product cost, like we reflected in the cost of goods sold, will include all of the three manufacturer cost items related to the units sold. So means all of your variable manufacturer cost and the fixed manufacturer cost will be captured by the units sold. So we have direct material, direct labor, then all of your variable and fixed manufacturer overhead included under the cost of goods sold. And in most times, the company will have some units unsold to customers by the end of the accounting period. So finished at unsold units. Under the absorption costing concept, the unsold inventory of finished good will also include their cost, include direct material, direct labor, variable manufacture overhead, and some of the fixed manufacture overhead. So in that case, not all of the fixed manufacture overhead will be expensed in the income statement, only the portion related to the sold units. Then some portion of the fixed overhead will stay in the finished good inventory. So in other words, we say the unfinished, so unsold finished inventory will absorb some of the fixed manufacture overhead as a result. So that's where the original name of the absorption costing come from. So you have a split of the fixed manufacture overhead. Most of them are included in the cost of goods sold with the units sold, and some of them are absorbed by the finished good inventory, so they will stay in the balance sheet. The benefits of using the absorption costing to prepare the income statement is this consistent with the manufacturer cost concepts we introduced in the beginning, and that will ensure the pricing set up by the cost of goods sold will be adequate enough to cover all of the manufacturer cost and generate adequate profits for the company eventually. So absorption costing. And then all of the period cost, the sales, admin, and the general expenses, doesn't matter is variable or fixed, will be deducted as period cost in the income statement under the absorption costing concept. On the other side, if you use the variable costing concept to prepare income statement, it will be like the contribution margin income statement we used in Chapter 6. Under this framework, when we prepare like the cost of goods sold, you only include the variable manufacture cost, direct material, direct labor, and variable manufacture overhead. The important difference is you exclude, so move all of the fixed manufacture overhead as pure rate cost. So this is the key difference between the variable costing and absorption costing, the different ways we treat the fixed manufacture overhead. So under variable costing, all of the fixed manufacture overhead will be deducted in your income statement. Not a single dollar of the fixed overhead will be absorbed by the unsold finished goods. So all of the total fixed overhead is expense. So in that case, that will cause the profit number under the variable costing and the absorption costing will be different when the production units and the sales units are different, because we put a different amount of the overhead deducted in the income statement. Under variable costing, the profits will be directly related to the sales volume. So the more sales units the company can make, the higher profit they can earn for the period. So it's showing a direct relationship between the sales volume and the performance. So if you evaluate the manager's performance using the variable costing, so it's very straightforward. The performance is purely based upon the sales volume. So it's better for performance evaluations. And it will motivate the managers to focus on the sales promotion so they can show better performance. But this is in contrast to the absorption costing, as we explained. Under the absorption costing, some of the overhead will be absorbed or buried in the balance sheet by the unsold finished good. So for the manager's performance, if the inventory level increase, the finished good increase, so they haven't sold as many units as they want. The surprising things is in the income statement, you still see a rising profit, like net income, because the rising inventory of finished good will absorb some of the fixed manufacture overhead. So the performance and the sales volume will be inconsistent and it cause confusion when evaluating the manager's performance. So pros and cons, advantage and disadvantage for the two forms of income statement. Also, that's the key difference between the two type of costing system. And they are not really working in conflict with each other. Okay, they are not exclusive with each other in business management. So we can use them in the same time, but for different purpose. Variable costing, we use it for internal management, like cost analysis, performance evaluations. Absorption costing, we use it for providing information for external users, setting up long-term pricing of the products. Okay, so that's the key, like a takeaway for the variable costing and absorption costing. And in the homework, number 1 and number 2 are related to the understanding and the application of the two cost concepts. Number 1, the question is a direct application of the concepts, so we can calculate the absorption costing per unit and the variable costing per unit. So it's not really a complicated question. It's based upon the given items for the units produced, the units sold, and the variable costing per unit and the fixed cost. So we can figure out the absorption costing per unit. So you have direct material, direct labor, variable manufacture overhead, which have the information given by the question directly. The only thing you need to calculate by yourself is the fixed manufacture overhead per unit. In this case, be careful, we use the total fixed manufacture overhead divided by the units produced. Be careful. The manufacture overhead fixed incurred for all of the units we produced not only the units sold. So we'll convert the fixed overhead on the per unit base. We need to divide by the 14,000 units produced rather than the units sold. Okay, so that's something, be very careful. So it's $49 per unit. So adding them together will be the total absorption costing per unit. So that can be like a multiple choice question. And then under the variable costing, we are only including the variable manufacturer cost. Be careful. Variable manufacturer cost do not include the variable selling and admin expense. So variable but manufacturer cost. So only 3 items are included in the variable costing per unit. So this is the question number 1. Question number 2, push this a little bit to a broader. So in this case, so similar question based upon the given information we are trying to find out. We also they give you the absorption costing income statement already, and it's required we found out how much the manufacturer overhead absorbed it in the unsold finished goods or hiding in the unsold finished goods, and then prepare a contribution margin or variable costing income statement. So how we can find out the manufacturer overhead, fixed manufacturer overhead included in the ending finished goods? We need to find out, so this is the how much fixed overhead per unit, per produced units. So 56,000 total manufacturer overhead fixed, divided again by the units produced. So $280 per unit. So if you divide by the units sold only, the answer will be wrong. So we use this one and multiply by the 20 units in the ending inventory. How we can know is 20 units? Because by the units produced and by the units sold. So units in the ending inventory, this is their finished. We finish the good inventory, not other. So 20 units. So we sold 180 and then 20. So the cost related to the 180 units will be the cost of goods sold. And then for the 20 of the manufacturer overhead, it will be absorbed by the finished goods. So 5,600. So under the finished good, we absorb $5,600 of the fixed manufacturer overhead. So that's the answer for number 1. And the number 2, the variable costing income statement. So this one, we got the same revenue from the absorption. The revenue will not be different between the 2 income statements. But under the variable cost of goods sold, we only include the variable manufacturer cost, which is 500 multiplied by the 180 units, the sold units. And the variable selling and admin is the 30. So it's given with variable selling and admin. So we have the explanations in before the tables. So 180 times 30, that's the variable selling. So you got all of your variable expense. So that's like the variable cost of goods sold, only the variable manufacturer cost. So the contribution margin is the same concept we used in chapter 6. and then all of the fixed manufacturer overhead and the fixed selling and admin expense will be deducted as period cost. But on absorption, we have a break of the fixed overhead between the sold units and unsold units. So net operating income is 2,800 under the variable costing, which is different from the absorption costing. Absorption costing has a higher net income because the 5,600 absorbed fixed manufacture overhead. So if you want to reconcile the difference, so we have 2,800 here, and the difference is the fixed manufacture overhead absorbed by the finished good inventory under the absorption costing. You can see that will exactly, this is the reconciliation between the two costing income statement. Variable costing is lower, but absorption costing is higher. Okay, so quickly, let's help us figure out the difference between the two income statements.